But let me, straight up go to our first guest for the show today. We have Bhise, who's the Managing Director and Co-Head of Research and the lead BFSI analyst at JM Financial Institutions. And he's speaking to us from the backdrop of the JM Financial India Conference 2024. It's titled India Rising, Resilience to Resurgence. Welcome, Samir. Good morning. Good having you here. Samir, talk to us about what are those three key facets that's really stood out for you as part of this conference.
Yeah, hi, good morning. Thank you for having me on the show. So I think we start tomorrow. The critical element that everyone is looking at is how resilient is the underlying growth trend. The earnings season has not been so enthusiastic as one would have expected it to be. There were pockets of optimism as well as some disappointments. I think so. The conference comes at an opportune time to get a sense on how the on-ground demand as well as economic activity is shaping up. While there was some anticipation of the fact that the monetary tightening that has been in place for last 12 to 15 months, as well as some bit of slowdown running into the elections earlier part of this year, may percolate. But I think the recent correction probably comes just because of the fact that there is a bit of some somberness on economic activity. As we enter the second half of the year and probably CY25, I think companies which will show resilience with respect to growth, clearly market is looking at them quite optimistically, and that is all what this conference is all about. Resilience to resurgence is what we've titled it. And I think hopefully at some point in time when we have a rate cut towards next year, we should see some amount of earnings growth as well as demand coming back. So yeah, that's the gist of it.
Samir, if I were to take out a few big takeaways from the Q2 numbers, which will likely get discussed as part of the conference, it's that growth has slowed down a little bit. You've also seen that margins have, in some pockets, or rather in a large number or in a majority of the pockets, have started to see a bit of a taper off. What is your key takeaway from Q2, and what do you expect to learn from the coming couple of days?
So I think one trend which is quite evident is parts of urban India have been slowing down, which is slowing in most of the consumption basket. Value retail continues to do well, and that is also visible. Pockets of unsecured lending have thrown stress, especially microfinance as well as some of the unsecured lending segments in the frontline names as well. At the same time, a lot of manufacturing companies continue to deliver good numbers. We will look for CY25, wherein some amount of stance neutralization by RBI should help, which will help economic activity going forward. And once this tightening of credit, which began sometime last year, especially in consumption-led segments, is behind us, and hopefully the pain which has caused with respect to asset quality as well as lenders tightening their belt is behind us in the next 1 to 2 quarters, we should see normalcy coming back in some of the consumption segments. So I think these are few segments which the market is looking at. At the same time, there are pockets such as automobiles, wherein the festive season has been kind of a mixed bag across. So I think there will be inquisitiveness amongst the investor communities on how the next year is going to shape up. At the same time, outlook on credit quality. Generally, large banks have kind of withstood this difficult environment quite well. So as we go into CY25, what is the outlook on credit uptick as well as overall consumption?
Right. And, Samir, great way to end this answer because it gives me a good platform for my next question, which is on lenders. Of course, you track lenders. You've been tracking them for a very long period of time. This has been a quarter where asset quality has come into focus for investors. And it's been a tale of two different types of companies. One is someone like a Fusion Micro, and without taking names, I'm just illustrative. Someone like a Fusion Micro, which is down 20% today, And then you have something like a Muthoot, which is up 6.5% today. And that's just about today. You talk about the broader quarter as a whole, and you'll see wide shifts in terms of the performances. Talk us through your observations.
So I think what this quarter is reflecting is what was actually started probably 2 quarters back, when RBI clearly highlighted that they want growth in unsecured lending segments to slow down meaningfully. And we have seen that in most of the times across cycles, that when credit is tightened, it also reflects not only in slower growth as well as slight bit of worsening of asset quality, because money is tight and the end borrower class then does not have access to credit, results into some bit of delinquencies. So I think this started somewhere around Jan. 2Q is probably the manifestation of what has percolated in last 9 to 12 months. Our sense is we are probably close to seeing the worst of it. I may not want to call it whether Q2 was the worst, or probably Q3 will see a similar level of numbers. Sometime in next year, which is probably is my base case, especially around 1Q26, we should see that large part of it has been absorbed and behind us. And especially on microfinance, I think the systemic trends have been visible, that there was over leveraging in pockets. Given that these are relatively shorter tenor loans, we should see that the pain flows through large part of FY25, and hopefully FY26 is a reasonably better year from what we have seen as we stand today.
Right, Samir. And Samir, I know time is always short with you, but just talk us through what JM Financial's top picks are in this environment, especially from a lending perspective. What are those names which will stand out? Because you might also have rate cuts coming through. So which are those specific companies which you believe are well placed for that as well?
So I think would not want to take specific names right now given the disclosure stance, but we clearly prefer larger private sector banks. There we have seen earnings have been reasonably resilient, and secured focused NBFCs continue to be our preferred place. Though one has to accept the fact that while last 3 to 6 months there has been a lot of optimism that RBI will cut sooner than later, I think that is just pushed out a little bit, given how inflation has moved, and RBI wants to see it through, that they actually take it fully under control. We continue to prefer that banks will probably outperform some of the non-banks.
Okay. Thanks so much for that, Samir. It's great having you, and wishing you all the very best for the next couple of days. Hope we have good insights at the end of that conference.
Thank you so much.
Right. With that, let's switch focus. We have Mangesh